Marty, go ahead.
Sure. I'll piggyback on what Andy said. It seems that deal flow has come back pretty rapidly. I'm as busy this January as I was last January, pre-COVID. So if businesses have returned to sort of normal EBITDA levels, and we're in the market or going to the market last year, pre-COVID or maybe early COVID, I think they're back now. It was busy in the fourth quarter, and it's continued into January. And there's some quality deals that I'm seeing. For a while there, I didn't see that many what you would consider quality assets that were going to draw sort of big multiples that Andy had referenced. But the deal flow seems to have come back, and I expect it to continue to be strong through the rest of the year.
Thanks, Marty. Let's go over to Scott. Scott, your thoughts?
Yeah, I'd echo what Marty said. I mean, deal flow coming into the beginning of January is just as brisk this year as it was last, although there is a cast of characters that are nowhere to be found. Hotels are almost impossible. Restaurants all have their individual struggles. Retail has also been majorly impacted. Indoor amusement centers, family entertainment centers, those things which were kind of a perennial staple in the Main Street to lower middle market space, especially with SBA deals, are still on a timeout. They're on the bench outside of the principal's office until further notice. But what I have seen is a lot of strategic acquisitions, businesses that flourished or even took advantage of some opportunities to improve their business, strengthen the bottom line during COVID. See a lot of lower middle market deals, fewer Main Street deals. So deal flow right now, the average deal size I'm seeing is probably about 50% larger than it was a year ago.
Thanks, Scott. Andy, go back to you. Do we have you, Andy?
I'm on my handset. Does this sound a little better?
Much better. Go ahead.
Should I assume that nobody heard the pearls of wisdom I was sharing?
Just start. Yep, I would start over.
All right. So briefly, I was beginning by sharing that even since the presentation at the top of the hour was done, we have our fourth quarter data. And as expected, volume was off the charts. The 230 private equity firms in our sample completed 115 deals in the fourth quarter of 2020. That compared to 50 in the third quarter. Second quarter was even less. So a lot of pent-up demand, a lot of deals done. The average valuation on that group was 6.9 times. So some pickup from the third quarter, not quite at the average in the low sevens that we were seeing pre-COVID. And I think that's very consistent with what Scott and Marty have been saying, that, if you just listen to deal people talk, it sounds like everything is being done at 7, 8 times EBITDA or more. And certainly there are businesses that are trading from positions of strength that only got enhanced by, testing during the past year, or that became more valuable against the background of a global health pandemic. But there are other businesses, and Scott was giving some examples, that don't have the luxury of staying on the sidelines, or, where you have owners that, were beaten up and want to sell. So valuations on those businesses are going to be more modest and pull down the average. But overall, in middle market M&A, this year is off to a booming start.
Andy, a follow-up question to that, what's the buyer or investor mix as you see it? Private equity, strategic, et cetera?
Well, I think both. I'll also say that in our data, and I haven't had a chance to really get into this, an unusual percentage of deals done in the fourth quarter were done with no debt. So you still have some very conservative buyers over equitizing. I think strategic buyers were, as a group, able to remain more active, or chose to remain more active than financial buyers during the toughest months of the pandemic. Overall, public stock values came back pretty well, and they were able, public and private strategic buyers were able to go after the businesses that they wanted. I think you're going to see financial buyers returning to the market with a vengeance now. In the past year, a lot of attention on paying attention to portfolio companies with varying levels of operational and credit exposure, and maybe looking at selected platform acquisitions, but much more visibility on the market. And this gets back into Marty's and Scott's world. Not just an enormous amount of equity dry powder available, but a lot of debt providers who are looking to put capital to work and have been able to tune up their offerings over the past 9 months.
Thanks, Andy. I think you had a question for Marty and Scott, actually. You want to fire that away?
Well, yeah, I do. I mean, along those lines, I look at, in a way, I mean, COVID was a lot of things, but, from looking at it from the perspective of providers in the leveraged finance market, I see it almost like, when you're in school, a snow day the night before a big test. There were people who were prepared and ready to go, and, coming out of the snow day, they're still ready to go. There were other people who got a break. They weren't prepared 9 months ago, but they've had a chance, as I said a moment ago, to tune up their offerings. And I'm thinking of, non-bank lenders that were able to deal with problems in their portfolio, commercial banks that, solidified customer relationships, sub-debt providers who, had time to, figure out, better answers to competition from the unitranche product. So, I mean, I really can't think of a way of continuing the snow day analogy, but, just as a non-lender, it feels to me like everybody's back on campus and ready to go. And I'm just curious, from your different perspectives, is that an oversimplification, or does that sound right?
Hey,
Marty, do you want to start?
Yeah, Scott, real quick. It looks like there was a question here from Reed Vanderlyk. Did you see that question?
Yeah, let's go there. So this is to Scott Stevens. Are you seeing any concerns from underwriters regarding those who receive PPP loans and their ability to grow or acquire other businesses, and any extra diligence because of their decision to utilize the PPP program? Scott, you want to start there? Maybe Marty fill in the blanks if he missed anything?
Sure.
Yeah, it's a really great question. COVID is constantly a topic of discussion in any business acquisition, strategic or otherwise. I think the better question to ask is, or to differentiate, is between draw number one, which was last April, or in the midst of draw number two, which we're in right now. If people are lining up for draw number two, we might be a little hesitant to take them too seriously. The unintended impact of draw number one, which I think rolled out officially April 2nd or 3rd of 2020, was that there were very loose parameters for whoever could apply. You had to have 500 or less employees. You had PPP loans going up to $10 million, and other than a couple of details, that was about it. So even the companies that were not suffering, were taking that money, and they almost kind of had to, because if they didn't, their competition definitely was. So it was a little bit of a horse race in a couple different categories. You had the people that were struggling to make payroll. You had some companies that really didn't feel the effects, but didn't want to get pushed out of their market or overtaken by a competitor. So nowadays when we're looking at people that took PPP loans last year, we're taking that with a grain of salt, seeing how they're coming back, looking at some trailing financial performance, and then looking at the integrity of the proposed transaction, especially if it's strategic. For those who are in line for PPP funding in draw number 2, a little bit of a different beast, and there could be some merits for why they're doing that and looking at an acquisition, but underwriting and credit management is definitely taking a look at these on a case-by-case basis, just trying to make sure it makes sense, and also, contending with all the details of the forgiveness piece of those PPP programs.
Marty, anything to add there?
The only thing I would add is depending on how material the PPP loan is to enterprise value. Here's an example. I'm looking at a refinance that they're refinancing their existing capital providers out, and they got a PPP loan that is pretty material to the refinance. It works really well if it's forgiven, and it doesn't work that well if it's not forgiven. Very, very confident it will be forgiven, but they don't want to pull the trigger on the refinance until a week after that loan has been forgiven. And this has been a while. They've been waiting, so we're waiting to pull the trigger on this. And I'd say the same thing in sort of a sale process. If you got a PPP loan, utilize the funds, and you're trying to sell your business or want to sell your business, if it's material to the enterprise value, you're going to wait until that PPP loan has been forgiven, just for the increase in the equity value of the company after it's forgiven.
Thanks, Marty. And maybe just going back to if you guys have any other additional comments, we'll wrap up. If there's no other questions from the group. Back to Andy's original question, if you guys want to weigh in on that a little bit.
Go ahead, Scott.
Well, now I'm trying. I got PPP on the brain now. I'm trying to kind of think back about what Andy was talking about. But, there does seem to be a very specific set of buyers out there. And I do think that, the amount of debt that's available out there and the people that are looking to position that debt is a pretty unique scenario that we're in right now. It's going to be curious to see how this pans out. I hear a lot of discussion amongst people I work with, both internal and external to my organization, or referral sources, that sort of thing. And, a lot of people are really looking at some of this stimulus funds in the form of PPP or stimulus checks or whatnot. They're like, oh, that's great. You could talk about the pros and cons of that. But, I have a lot of folks that are really looking at, hey, vaccinations, that could be the best stimulus that we have as a country or as a world. The faster we can get to that tipping point and get on the other side of this whole mess, that could have a really fantastic financial impact on all aspects of business, whether it's, being able to keep your doors open, being able to acquire other businesses. I do see fewer and fewer corporate, refugees looking to buy businesses right now. I think that drives a lot of the interest in the lower middle market acquisitions for folks that have been previous business owners or maybe they're current business owners. I referenced that, I think, in one of my earlier slides. So it's a really interesting time, and I think every month we're going to have a different opinion on what the next month is going to look like.
The only thing I would add, and it piggybacks on what Andy said, was if you were a financial buyer, if you were a funded capital, if you're a private equity firm that has a fund, you spent a lot of time, 10 months last year, tending to your portfolio, helping them get PPP, not focused on investing. That sets private equity firms back on their investment horizon by probably 10 months. So they will be anxious to put their money to work in 2021. If you're a business owner that has a business that was unimpacted by COVID or did well during COVID, and you're considering selling the business, I think those are the businesses that could garner higher valuations in this market coming up, just because of the amount of capital that's available out there.
Thanks, Marty. And I don't see any other questions coming in here. So in the spirit of time, I want to thank Andy and Marty and Scott for your time. I think we managed through this technology about as best as we could. And appreciate all the help from everyone involved. Looking forward to seeing everybody hopefully in person in May. And with that, we'll end the winter meeting. Thanks, everyone.
Thank you.
Thanks, Scott.
Thank you.